Imagine you're a statutory auditor or maybe a credit analyst, right?
Yeah.
And you're reviewing the published balance sheet of this publicly listed company.
Right.
So you scroll past the current assets, the usual stuff, and you move down into the non-current assets section. And as an experienced professional, your brain is already primed for what should be sitting in this section.
Exactly. You're expecting the heavy stuff.
Yeah, the heavy, illiquid infrastructure of the enterprise.
Yeah.
Like the property, plant, machinery, maybe some long-term strategic investments. But then right there in the middle of this long-term block, you trip over this massive, nearly 600 million rupee anomaly.
Oh, wow.
Yeah, it completely shatters the fundamental categorization logic of the entire financial statement.
Ah.
And it's just sitting there. So today, we are going to look at how a seemingly innocent, common-sense calendar assumption resulted in a spectacular, highly public misclassification of the very assets that keep a business breathing.
It really is a fascinating case.
It is. So welcome to a brand new deep dive on the JAP Advisors IndAS Clinic podcast. Whether you are commuting, maybe prepping for a complex audit committee meeting, or just, reviewing your own working capital models, we are going to dissect the exact mechanics of this real-world reporting failure.
But before we dissect the standard, we really must establish the boundaries of our analysis today. It's critical to note that the views expressed in this deep dive are the personal views of the author, and they are absolutely not binding on the audience.
Right. Very important to mention that.
Yeah, we are examining technical interpretations of Indian accounting standards based on published data, but you are strongly requested to seek the help of an independent expert before taking any action or, refraining from any action based on the views we discuss herein.
Definitely.
Financial reporting is highly nuanced, and your specific professional context must always dictate your final judgments.
That is a vital baseline, so thank you for that. So let's outline the precise mission of today's deep dive. We're investigating a fascinating real-world observation regarding the application of IndAS 1.
Which governs the presentation of financial statements, right?
Exactly. We are looking at a specific excerpt from the published IndAS financial statements of an actual listed company.
And, the origin of this observation is just as important as the numbers themselves.
Oh, absolutely.
This financial statement was downloaded and independently reviewed by GAAP advisors on a suo motu basis.
And for anyone who isn't familiar, that means this wasn't a client submitting a query for consultation, right?
Right, exactly. This was GAAP advisors taking their own initiative, pulling publicly available financial data from a listed entity, and rigorously testing it against the standards, just to see how IndAS is actually functioning out there in the wild, in the market.
It's basically the ultimate pressure test of public reporting. And this specific observation, detailing this massive misclassification, well, it was featured in the 227th edition of the GAAP Advisors Task Weekly newsletter.
Yes, which is an incredible resource.
It really is. That newsletter is authored by C.A. Manish C. Iyer, Director of GAAP Advisors, and it's published directly on LinkedIn.
It's an indispensable resource for anyone working within this framework. And just to give you an idea of the consistency and the sheer depth of this resource, 232 editions have been published till date.
Wow, 232.
Yeah. So if you are active on LinkedIn and you are responsible for financial reporting or auditing, I highly recommend you subscribe to the newsletter. It's completely free, and it consistently bridges that huge gap between theoretical standards and messy real-world application.
Okay, let's unpack this financial statement. We need to set the scene of the financial reporting period first. So for absolute clarity, we are operating within the Indian financial year, which runs from the 1st of April to the 31st of March.
Right, that's the standard cycle.
Yep. The reporting period we are zeroing in on ends on the 31st of March 2020, and we are comparing it directly to the previous year ending 31st March 2019.
Okay.
Furthermore, every single figure we're about to discuss is denominated in Indian rupees.
Perfect. Because, when you look at a comparative balance sheet, you aren't just looking at static numbers, right? You are looking for velocity and placement. The placement of an asset dictates how a reader assesses the risk and the liquidity of the enterprise.
Exactly. It's all about where things sit. So let's walk through this specific snippet of the balance sheet. We're looking exclusively at the non-current assets section.
Okay, let's jump into the number.
Right. First up in this section, we have property, plant, and equipment. On March 31st, 2019, the balance was, 35,461,939 rupees. By March 31st, 2020, that number had shifted slightly down to 35,157,914 rupees.
Okay, so that is a very standard progression. I mean, a slight decrease of around 300,000 rupees over a 12-month period typically indicates routine depreciation of the asset base.
Yeah, that makes sense.
It might be slightly offsetting some minor capital additions, but basically it tells the reader that the core physical infrastructure of the company is stable. It belongs exactly where it is in the non-current section.
Perfect. Moving down, we see investment property. Now, in 2019, this sat at 42,221,532 rupees. In 2020, it grew significantly to 65,947,625 rupees. So they've deployed roughly 23.7 million rupees into real estate, held for rental yields or capital appreciation, rather than for use in normal operations.
Again, structurally perfect. Investment property is, by its very nature, a long-term strategic hold. You don't purchase land or commercial real estate with the intention of liquidating it within the current operating cycle.
Right, you're sitting on it.
Exactly. Its placement in the non-current section perfectly aligns with the economic reality of the asset.
Okay, now we reach a subheading under non-current assets titled Financial Assets.
Okay, here you go.
The first line item here is investments. On March 31st, 2019, they held a massive 480,023,639 rupees in non-current investments.
That's a huge number.
Yeah, but look at March 34th, 2020. That number has plummeted to 99,414,538 rupees.
Wow. Okay, that is a severe liquidation event. They have unwound nearly 380 million rupees worth of long-term financial investment.
Like what exactly? What would that be?
Well, it could be equity stakes in other entities or maybe long-term bonds, right? And they unwound it over the course of a single financial year. That tells an analyst that a massive amount of liquidity was injected into the company.
Okay, so they freed up a ton of cash.
Yes. And whether that cash was used to fund operations or, pay down debt or maybe distribute dividends, that is a separate analytical question. But purely from a presentation standpoint, tracking the liquidation of a non-current investment like that is standard practice.
Right below that, still under financial assets, we have loans. This one is static. 18,000 rupees in 2019 and exactly 18,000 rupees in 2020.
Likely security deposits or maybe a long-term advance to a related party that just hasn't moved. It's a stable, non-current financial asset. Nothing crazy there.
Okay. And now we reach the anomaly.
The big one.
The massive boulder sitting in the middle of the highway. Under this exact same non-current financial assets heading, there is a line item for trade receivables.
I mean, just hearing the phrase trade receivables under a non-current heading, it should immediately cause a statutory auditor to halt their review and demand an explanation.
It's crazy.
Yeah.
And it becomes much more alarming when you look at the sheer scale of the numbers. On March 31st, 2019, these non-current trade receivables were listed at 88,126,059 rupees.
Okay.
But on March 31st, 2020, that figure erupts to an astonishing 599,900,734 rupees.
That is an increase of nearly 580%.
It's nearly 600 million rupees.
Yeah, that is staggering.
Now, we could spend hours discussing the underlying business trauma that causes a company's uncollected receivables to spike by 580% in a single year, right?
Oh, absolutely. Especially while they're simultaneously liquidating 380 million in long-term investments.
Exactly. That paints a picture of a company potentially starving for operational cash flow, maybe extending desperate credit terms to customers just to keep the lights on. But the mystery we are solving today is not the credit policy. It's the accounting classification. Why is this nearly 600 million rupee balance sitting squarely under the heading of non-current assets?
Because it fundamentally breaks the categorization logic of the framework. I mean, trade receivables are the direct, immediate byproduct of a company's core operations.
Right, it's the everyday business.
Yes. They represent revenue that has been earned but not yet collected. They are the absolute antithesis of a long-term strategic hold, like, say, an investment property.
Exactly. I was trying to conceptualize how jarring this is for a reader, the financial statements. It's like walking to a massive hardware store. You are in the aisle with the industrial power drills, the heavy sacks of cement, the lumber things that represent long-term construction.
Okay, I like this analogy.
Right. And right there, sitting on a pallet next to the concrete mixer, is a massive, highly perishable carton of milk.
Wow. Yeah.
It's not just that there's an overwhelming quantity of milk, it's that the milk fundamentally does not belong in the hardware aisle.
No, it belongs in the refrigerated section at the front of the store because it has an immediate expiration date.
Yes. By placing nearly 600 million rupees of trade receivables into the non-current section, the company has taken its most highly perishable operational asset and categorized it as industrial lumber.
What is fascinating here is the cognitive dissonance required by the preparer to actually make that placement. I mean, to understand how a listed entity could make such a profound structural error, we really have to move away from the raw data and decode the rulebook.
Let's do it.
We have to look at the precise wording of IndAS 1, Presentation of Financial Statements, specifically paragraph 68.
Let's dive directly into that text. Paragraph 68 is the ultimate gatekeeper, right? It dictates exactly what is permitted to enter the current assets classification. And it all hinges on one very specific, sometimes highly debated concept, the entity's normal operating cycle.
Yes, the operating cycle. It is basically the metabolic heartbeat of the enterprise. Paragraph 68 provides a very clinical definition. It states, and I quote, "The operating cycle of an entity is the time between the acquisition of assets for processing and their realization in cash or cash equivalents."
Okay, I want to break that definition down because it sounds simple, but in a modern multi-vertical conglomerate, it can be incredibly opaque.
Very true.
The acquisition of assets for processing. Let's bypass the standard textbook example of buying raw materials for manufacturing, like, buying cotton to make shirts. What if the company is an EPC contractor? Engineering, procurement, and construction. Let's say they're building a massive hydroelectric dam.
Oh, that is an excellent stress test of the definition. For an EPC contractor building a dam, the acquisition of assets isn't just buying cement.
Right, it's way more than that.
It is the mobilization of heavy machinery, the deployment of engineering teams, the securing of environmental permits, and the processing phase is the actual multi-year construction of the dam itself.
So the processing phase could take 4, 5, maybe even 7 years.
Precisely. And the cycle doesn't end when the dam is physically built. It continues through the billing milestones, the retention money held back by the client, until the final phrase of the definition is met, and their realization in cash or cash equivalents.
Well, the cash actually has to be in the bank.
Exactly. The operating cycle of that specific dam project only closes the moment the final rupee of the retention money hits the contractor's bank account.
Wow. So for that specific business unit, a single operating cycle could easily stretch to 8 years. It's the total lifespan from the initial cash outflow from mobilization to the final cash inflow of the completed contract.
Yes. That entire 8-year timeline represents one breath, one complete metabolic cycle for that specific operational unit.
But I have to push back on the practicality of this. You and I both know that listed companies rarely do just one thing.
Fair point.
What if this EPC contractor also has a separate division that simply manufactures and sells precast concrete blocks, where the operating cycle is maybe 30 days?
Right, a much shorter cycle.
If a company has 10 different divisions,
Yeah.
with operating cycles ranging from 30 days to 8 years, how does an auditor or a CFO define the normal operating cycle for the consolidated entity? Doesn't that ambiguity just invite chaotic, subjective reporting?
You are hitting on the exact operational friction that the standard setters anticipated. It's true that in complex conglomerates, blending these distinct operational timelines can become mathematically and logically absurd.
Yeah, you'd just be making up a number.
And that is exactly why the text of IndAS 1, paragraph 68, provides a strict overriding failsafe. It explicitly states, when the entity's normal operating cycle is not clearly identifiable, it is assumed to be 12 months.
Ah, the 12-month default. Okay, so if the operational reality is a tangled web of 30-day cycles and 8-year cycles, and management cannot clearly define a single representative normal cycle for the entity, the accounting standard just removes the subjectivity entirely. It imposes a rigid calendar limit.
It's a necessary backstop. The 12-month assumption exists to ensure comparability.
Comparability between different companies, you mean?
Exactly. If an investor is looking at two complex conglomerates side by side, they need a baseline to assess liquidity. If the actual cycle is obscured, 12 months becomes the universal proxy. It stops management from simply inventing a conveniently long operating cycle to, artificially inflate their current ratio.
Okay, so we have two distinct frameworks running in parallel here. We have the true identifiable operating cycle, however long or short that may be, and we have the default 12-month calendar assumption that kicks in if the true cycle is unidentifiable.
Exactly. And I want you to keep that tension between the operational timeline and the calendar timeline at the forefront of your mind, because it is precisely where the preparers of this financial statement derailed. The next sentence in paragraph 68 is the absolute crux of the misclassification.
Okay, let me read this sentence straight from the source. This is the mandate that seals the fate of the balance sheet. It says current assets include assets, such as inventories and trade receivables, that are sold, consumed, or realized as part of the normal operating cycle, even when they are not expected to be realized within 12 months after the reporting period.
There it is.
Here's where it gets really interesting. This specific phrasing essentially grants trade receivables an absolute VIP pass to the current assets classification.
The VIP pass is the perfect way to conceptualize this mechanism. Explain how you see that functioning in practice.
Sure. Think of the current assets section of the balance sheet as an exclusive club. Normally, to get past the bouncer, an asset has to prove it meets the calendar requirement, I will convert to cash within 12 months. That's the standard entry test, right?
The basic rule.
But then, trade receivables walk up to the door. The bouncer asks, are you going to convert to cash in the next 12 months? And trade receivables reply, no, I'm tied up in extended credit terms. It might take me 18 months, maybe 24 months to convert to cash.
And usually, that would be a rejection.
Exactly. Under normal logic, the bouncer would send them away to the non-current section. But because of paragraph 68, trade receivables can point to the rulebook and say, it doesn't matter how many calendar months it takes. I was born directly out of the normal operating cycle. My very nature is operational.
I love that. My very nature is operational.
Yeah. And because of that operational lineage, the bouncer has to open the door. They are granted automatic entry into current assets, completely bypassing the 12-month calendar restriction.
That is a flawless interpretation of the standard's intent. Paragraph 68 specifically isolates inventories and trade receivables in parentheses for exactly this reason.
It calls them out by name.
It does. The standard is making a profound philosophical statement here. The nature of the asset supersedes the calendar timeline of its realization. If a receivable is generated by the normal operating cycle, it is inherently a current asset because it represents the final, uncollected phase of the entity's core metabolic function.
It's the lifeblood.
Right. To classify it as non-current would be to falsely equate it with a long-term capital investment.
Oh, wait, let me challenge the philosophy of that for a second.
Go for it.
If I am a banker and I'm looking at a company's current assets to determine if they have enough immediate liquidity to survive the next 6 months, and I see a massive pile of trade receivables sitting in the current section.
Yeah, you assume there'll be cash soon.
Right. But it turns out those receivables aren't going to be collected for 3 years because of the nature of the operating cycle. Hasn't this standard just actively misled me? By giving trade receivables this VIP pass, isn't IndAS 1 artificially inflating the appearance of short-term liquidity?
That is the fundamental tension between presentation principles and risk analysis. But, the standard is not trying to do the banker's job for them.
Okay, that's fair.
IndAS 1 is designed to faithfully represent the operational structure of the business, not just provide a liquidation countdown. If a business normally takes 3 years to build a product and collect the cash, then a 3-year receivable is factually part of its current ongoing operations.
So what is the banker supposed to do?
Well, it's up to the banker to read the subsequent notes to the financial statements, look at the aging schedules, and apply their own liquidity haircuts. But purely from a classification standpoint, the standard demands that operational assets stay within the operational bucket, regardless of the calendar delay.
That makes perfect sense. The balance sheet reflects the business model, not just the bank account timeline.
Exactly.
So knowing that the rule is this explicit, that trade receivables are definitively current if they stem from the operating cycle, how did the preparers of this listed company's balance sheet make such a monumental error? I mean, how did nearly 600 million rupees of operational receivables end up parked under non-current financial assets?
It happens when financial preparers substitute basic heuristics for rigorous standard application.
Meaning they took a shortcut.
Yes. Put yourself in the position of the CFO or the financial controller finalizing these numbers. They are looking at an explosive 580% spike in receivables, jumping from 88 million to nearly 600 million.
Probably sweating profusely while looking at it.
Oh, without a doubt. They run their aging reports and realize that, perhaps due to macroeconomic stress or maybe a change in client contracting, a vast majority of these invoices are simply not going to be settled within the next 12 months.
Right. They see a massive delay in cash realization looming on the horizon.
Exactly. And in that moment of stress, they fall into a very common very dangerous logic trap. They revert to the absolute most basic elementary school definition of accounting.
Which is?
They think less than 12 months equals current, more than 12 months equals non-current.
Ah.
It feels intuitively correct, it feels conservative. They might even think they're being more transparent by pushing delayed collections into the non-current bucket.
They got entirely hypnotized by the calendar. They saw the time delay and completely stripped the asset of its operational identity. They forgot about the VIP pass.
Precisely. They conceptually decoupled the trade receivable from the operating cycle that created it. They treated it as if the company had taken 600 million rupees and locked it away in a 5-year fixed deposit at a bank, rather than recognizing it as the final waiting stage of a product that has already been sold.
That's a huge distinction.
It is, and this is exactly why paragraph 68 exists. The standard setters knew that human beings instinctively default to the 12-month calendar logic. So they wrote an explicit, unavoidable override to prevent this exact categorization error.
It's a perfect example of how relying on common sense rules of thumb, like long time means long-term asset, can lead a highly sophisticated listed entity into direct non-compliance with the reporting framework.
It demands constant vigilance. Indian accounting standards are deeply principle-based, but they embed these highly specific mechanical overrides to ensure that the economic reality of an asset is not distorted by arbitrary calendar cutoffs.
So let's synthesize all of this and deliver the final verdict on the published financial statements we've been dissecting.
Let's do it.
Based on the precise source material in IndAS 1, paragraph 68, the facts are inescapable. The company generated a massive balance of trade receivables. Trade receivables, by fundamental definition, are generated during the normal operating cycle.
Right.
The standard explicitly states that assets realized as part of the normal operating cycle are definitively classified as current assets, even if their collection timeline extends far beyond 12 months.
Yes. The logical chain is unbreakable.
Therefore, the conclusion is absolute. Trade receivables are part of the operating cycle. Consequently, trade receivables cannot be classified as non-current.
Yeah.
You cannot put the milk in the hardware aisle, no matter how long you expect the milk to sit there.
Which brings us to the final formal verdict, exactly as it was documented in the Gap advisor's observation. Accordingly, the company has not complied with IndAS 1.
Non-compliance. It's a heavy determination.
It is.
But we have to ask the ultimate so what question. If we connect this to the bigger picture, why does this misclassification actually matter to the market? Let's say I'm an institutional investor or a credit risk officer at a major bank looking to underwrite a facility for this company. The total assets of the company haven't changed. The 600 million rupees exists either way. Does it truly matter which specific bucket it sits in on the page?
It fundamentally alters the perceived reality of the company's financial health because it violently distorts the primary working capital ratios. Specifically, it destroys the current ratio, which is the foundational metric of short-term liquidity.
Let's trace the math on that to really highlight the impact, because this is where the rubber meets the road.
Please do.
The current ratio is calculated by dividing total current assets by total current liabilities. It's the immediate litmus test to see if a company can survive its short-term obligations. A healthy manufacturing-type business might target a current ratio of 1.5 or 2.0, meaning they have 1.5 to 2 times as many liquid assets as immediate debts.
Correct. So envision the mathematical impact of what this company did. They took nearly 600 million rupees of trade receivables assets that legally and structurally belong in the current assets numerator, and they exiled them to the non-current section.
Oh, wow. So they artificially evaporated 600 million rupees out of their own current assets total.
Exactly.
If a banker runs the calculation on the published face of the balance sheet, the current ratio is going to look catastrophic.
Yes. The company has essentially misrepresented itself as being severely illiquid. To a passing algorithm or, a junior credit analyst relying purely on data feeds, it looks as though the company might default on its payroll or its short-term vendors next month simply because it lacks the current assets to cover its current liabilities.
That is wild.
And the profound irony is that they created this appearance of distress by taking their most vital, core operational asset, the cash owed to them by their customers, and dressing it up as an illiquid long-term investment.
It completely warps the narrative. It's not just a victimless formatting choice. It's a fundamental distortion of the enterprise's risk profile. And this brings the conversation directly to the doorstep of the statutory auditors.
It absolutely does. The role of the auditor extends far beyond merely confirming that the 600 million rupee balance mathematically exists in the ledger.
Right, they aren't just checking the math.
No, their mandate is to verify that the presentation and disclosure of that balance strictly comply with the reporting framework.
This highlights the immense pressure on audit teams. When management presents a balance sheet where a normally current asset has been shunted to non-current, the auditor cannot simply nod and accept the "it will take longer than 12 months to collect" excuse.
They can.
They have to actively challenge the classification using the text of the standard.
This is exactly where the necessity for rigorous, systemic audit documentation becomes critical. When an auditor encounters a highly unusual presentation, such as a 580% spike in receivables that management insists on classifying as non-current, the auditor needs the technical ammunition to force a correction.
They can't just go off a gut feeling.
Exactly. They cannot rely on intuition. They need to point to documented precedent, expert interpretations, and the exact clause in paragraph 68 to compel management to adjust the presentation.
Which brings us right back to the incredible value of the tools we discussed earlier. If you're an auditor staring down a CFO who is adamant about a misclassification, having access to an independent, deeply researched knowledge base is basically your professional armor.
It truly is.
This is why the issue repository at gapadvisors.com is so crucial. We're talking about a database that hosts over 4,500 distinct issues and their meticulously detailed responses covering IndAS and Indian GAAP.
The scale of that repository means that almost any complex application issue an auditor might face has likely already been dissected and resolved.
That's amazing.
Yeah, and any person you listening to this deep dive right now can register for free on the platform. You can submit your specific complex issues regarding the application of IndAS or Indian GAAP, and you will receive a detailed, authoritative response delivered directly to the inbox of the email you registered with on gapadvisors.com.
Delivered right to your inbox. That's huge.
I cannot overstate how extremely helpful this is, particularly for auditors who bear the burden of documenting exactly how they addressed and resolved any contentious issue regarding the application of IndAS.
Right. It's the difference between writing discussed with management in your working papers versus attaching a comprehensive technical analysis that definitively proves the required treatment.
Exactly.
And if you're on the other side of the table, if you were the one preparing the financial statements, this entire case study leads to one simple, non-negotiable piece of advice. Get your financial statements reviewed by GAAP advisors before signing them.
Yes, before.
Do not wait for the market or the regulators or a suo motu review to find the carton of milk in your hardware aisle.
Preventative review is the hallmark of strong corporate governance. Identifying a structural non-compliance while the document is still a draft saves an immeasurable amount of reputational and regulatory friction.
Absolutely. And the process is incredibly streamlined. You can submit your financial statements in a near-to-publishing PDF format simply by emailing them to info@gapadvisors.com. It is a vital step in ensuring structural purity before the numbers go public.
And this raises an important overarching question for our listeners.
What's that?
Well, if a publicly listed company equipped with internal audit teams, specialized finance departments, and external statutory auditors can publish a financial statement where nearly 600 million rupees are blatantly misclassified simply because an individual defaulted to calendar logic instead of operational reality.
Yeah.
How many other balance sheets in the market are harboring similar misclassifications hidden in plain sight?
Oh, wow. That is a genuinely chilling thought for anyone whose job relies on accurate financial modeling. I mean, how many current ratios are artificially depressed? How many working capital cycles are completely misrepresented because someone assumed over 12 months automatically meant non-current?
It suggests that this is likely not an isolated incident. The psychological trap of equating calendar time with classification is deeply ingrained. Escaping that trap requires constant, deliberate engagement with the underlying principles of the standards.
Which is exactly why we do these deep dives. We have to continually test our assumptions against the actual text of the framework.
Absolutely.
So, as we bring this exhaustive investigation into IndAS 1 and the critical mechanics of balance sheet presentation to a close, I will leave you, our listener, with a final provocative thought.
Let's hear it.
If the foundational presentation of something as basic as trade receivables can be this fundamentally misunderstood by a major corporation, what other core assumptions in your financial models might you be taking for granted?
That's a great question.
When you return to your desk or when you open the next set of financial statements you're tasked with analyzing, do not just accept the categorizations at face value. Look at the balance sheets of the companies you audit, the companies you manage, or the companies you invest in. Are their current assets truly reflecting the dynamic, metabolic reality of their specific operating cycle? Or are they simply defaulting to a lazy, compliant 12-month calendar assumption that masks the true nature of their business? Question the categories. Do not just assume the architecture is sound demand to see the blueprints.
Critical analysis is the only defense against structural misrepresentation. The numbers only provide value if the underlying framework is rigorously applied.
Well said. We truly hope this deep dive has sharpened your analytical perspective and added a new layer of vigilance to your professional toolkit. But please, do not keep this analysis isolated.
No, share it.
Yes, share this deep dive among your contacts, send it to your colleagues, and forward it to your audit and finance teams. And crucially, if you know any students who are currently pursuing their CA course, please share this with them. Dissecting real-world reporting failures is the absolute most effective way to spread the knowledge of Indian accounting standards and bridge the vast gap between textbook theory and complex market reality.
Theoretical knowledge must be stress-tested against real data. We also invite you to engage with the concepts. Look for these anomalies in your own practice. Question the assumptions driving the classifications you see every day.
And with that, we will officially conclude today's analysis. We want to explicitly thank you, our audience, for dedicating your valuable time to this deep dive. We know how demanding your professional schedules are, and choosing to spend this time unpacking the intricate nuances of accounting standards with us is truly appreciated.
It really is. Thank you.
Before we sign off, if you found value in this level of detailed, uncompromising analysis, we have a quick request. Please make sure to follow or subscribe to the Gap Advisors IndAS Clinic podcasts. We are available on Spotify, on Amazon Music, and on YouTube, whichever platform you prefer to listen to Gap Advisors IndAS Clinic podcasts on. Hit that subscribe button so you never miss an analysis. Until next time, keep questioning the numbers, keep demanding clarity, and we will see you on the next deep dive.